I'm Danny Warshay. I'm the Executive Director of the Nelson Center for Entrepreneurship. I want to welcome you all tonight. Thank you all for being with us. I always like to do this at the start of any Nelson Center event. For how many of you is this your first event of the Jonathan M. Nelson Center? Great. I always love seeing new faces, so a special welcome to all of you. If you don't know, our website is entrepreneurship.brown.edu, and that's a really good place to learn a lot about what we do and also to sign up, if you're not already on our list, for our email updates. So you can, if you'd like, be kept apprised of all of our events. We have, today alone, we had 3 events. In fact, there's one after this. We have all sorts of things happening tomorrow, through the weekend, throughout the rest of our Brown semester. And we cover, I like to say, 3 buckets. One is curricular, so we teach courses, we do academic research. There's a very strong, rigorous academic underpinning to what we do. There are lots of these kinds of what we call co-curricular events. So workshops, speakers, opportunities for students and others to learn outside the classroom. And then we always say we not only teach people about entrepreneurship, we empower you to do it. So especially for students, we provide a whole range of venture support resources. And I'll call out one in the midst of grants that we provide and a summer accelerator that we run, a prize competition that we've launched recently. But the most recent one is a collaboration with Thorne and the Slater Fund, which is you're directing traffic and people to come in. Yes, and that is something called the Brown Venture Founders Program, which awards $50,000 to a graduating student to motivate them to start and launch and plant the seeds of their new venture here in Providence. And we kicked that off at the very end of the last academic year with our first awardee, Michelle Peterson of TechStup, and we will soon be making our second collective award. And as I transition to Thorne, I want to thank Thorne for a really wonderful relationship, collaboration between Slater and our Nelson Center. We are now doing a lot of these kinds of events and other activities that are always, as all of our events are, open to the general public. It's nice to see, frankly, almost all of you represent the community. I don't see very many students. It's midterms, so I think that might be distracting them. But I presume you don't have midterms distractions. And I do want to emphasize, because sometimes people are unsure, I'll say it again, all of our Nelson Center events are open to the general public and to the community. So I'm really thrilled that so many of you are here with us tonight, and I hope you will take me up on my offer to sign up if you're not already on our email update. You can do that again at entrepreneurship.brown.edu. So thank you again, Thorne. I'll turn it over to you, and appreciate your getting us started for tonight.
Yeah, so thanks, as always, to the Nelson Center. We're doing tons of stuff together. So thank you to Abby for putting it all together. As always, Abby, thank you very much. And Laura and Nancy from the Slater team. I want to just add on to the notion of the diversity in the crowd. Some people said they were new, but we have people from a diversity of institutions. I see Woods Hole represented, and URI. I see different cities from Cambridge to New York to Connecticut. So especially when you come and see a great presentation, next time, come bring someone else with you, an entrepreneur, a researcher. We want that genetic diversity, the gene drift into our pool here, and it'll be worth it. It'll pay off. All right, so I want, and our speakers here tonight, our panel is pretty far-flung as well, and I'm going to introduce them briefly. I can't even remember where we met first. It was maybe at a clean tech event. I've known Deb for years. She was spent time as a McKinsey consultant, so she's as smart as they come. Spent a lot of years overseas, and these days is coaching up entrepreneurs, investing through Golden Seeds and the Clean Energy Venture Group. Bob Place, I met at Brown University, probably at the B Lab. He is a Brown graduate, and then spent several decades building all sorts of power plants, wind, solar, and thermal, around the world, $7 billion worth of power plants. And these days is coaching entrepreneurs, investing, whether at Brown or through the Clean Energy Venture Group or the new fund with roughly the same name. And David, we met, again, I can't remember where. He is the archangel of the New York Angel Group, so comes to us from Manhattan, but originally an entrepreneur from Rhode Island in the traffic, data, and media space. Is that good enough?
That's perfect.
Would anyone like to add something about either your background or your current affiliations? No, they're all shy. Okay, that won't last long. So there's a lot of wisdom here, and I want you to save up your most insightful questions. And on the off chance that I don't ask them, we have a couple of microphones here. We were talking before we got started here. Organized angel investing is a new beast, not super new like last year new. But if you go back 15 years, there were not websites where you could get on there, upload your business plan, and be in front of 40, 50, or in the case of the New York Angels, 150 angels. So it's a new way of finding investors, and it's evolving. It's a new science, a new kind of institution, and we have here some experts today, and we're going to try and figure out the do's and don'ts of trying to raise capital in this group. So I guess my first question for the group is, we all know about venture capitalists. So let's compare angels and angel groups to venture capitalists. So how are they different? Is it that angels do the same thing that venture capitalists do, only in smaller deals, worse deals, earlier deals? Compare and contrast, and let's start with Deb.
Okay. So is this on?
It is.
Okay. So the way I always start to say this is the first thing between angels and venture capital is angels invest their own money. So they are literally writing you a check out of their checkbook. And so that relationship you make with, whether it's a group or with individuals in the group, they do want to know and put a lot of stake in the founders and the founders' teams. Whereas venture capital is using institutional money, right? Yeah, they may have a little bit of skin in the game, but primarily it's institutional money, right, that they're investing, and not as much of a personal risk at stake. And so I think that's the first thing I would lay out as a big difference between angels versus venture.
Yeah, I think the second thing I would suggest is that there's really sort of three stages associated with money for early stage entities. It's usually friends and family are the ones that help to get the idea off the ground. Then typically you see the angel community involved to help to bring it along through the initial seed round A's and B's, and perhaps the first Series A. And then the venture capital is a source amongst other sources that help move the company through the commercialization process. So, but there's different sources at different times.
Yeah, I would also say that because the ecosystem is still evolving, as Thorne mentioned, there's a lot of crossover now. So it used to be at New York Angels that we really invested in go-to-market strategy. So it would be a case where maybe your friends and family gave you the first round of capital, you got a minimum viable product, you did some beta testing, and you had some reason to believe that you had a product that you were ready to put out to market. And then you would come to us, and we would invest anywhere from $500 to maybe $800,000. The way that's changed now is we've been around and doing this a while, so that just because you're through that stage doesn't mean that we don't still want to participate in your later rounds. So very often we will also participate in an A round, or we will get together with other angel groups, and we will put together, a consortium that can actually provide much more funding. And probably a third of what we do now, maybe a quarter to a third, is actually follow-on investments. So all those lines are blurring a little bit.
So let me pick up on how much a given angel group is specialized and how you can figure out what they're specialized in. From anyone?
Yeah, I can start again. So a great resource is to go to Angel Capital Association, which lists all the, I'd say, the bigger angel groups or institutional angel groups, if you want to call them that. They all come in, they come in all different flavors and sizes. Some are just regional focused, and some are national, like we're a national group. Golden Seeds, for those that don't know, is a national angel group, almost 300 members nationally, focused on gender diverse teams. So a woman in the C-suite in an operating role with 10% equity is our threshold. So we're fairly sector agnostic, which is, I'd say, unusual, but because we have the gender lens, we choose to be more broad in terms of our sector base. There's others that are very specialized, and I'll let Bob talk because I'm a co-investor with him in a group that's very specialized.
Yeah, so I'm part of the Clean Energy Venture Group, which basically invests in companies that are primarily focused on reducing the carbon footprint, but it's a whole range of different types of technologies, whether it be software, whether it's hardware, whether it's a variety of different types of instrumentation. But the focus is historically has been primarily New England focused. Over the last 3 years, it now has become national and focused. And we have, in the last year, established an institutional fund that's affiliated with the angel side of the business, and we work hand in hand with the institutionals to move forward transactions. So we have now 2 sources of capital, but it's all focused on clean tech and advanced tech.
So one of the great things about joining an angel group for the members, and also it's a great thing if you're an entrepreneur looking to be funded, is that there is just a tremendously diverse level of expertise among an angel group's members. So when I became an angel investor, I was really focused on advertising. My old business had been in media, and I was really focused on finding what the next great thing was going to be in digital advertising. And I finally learned enough about digital advertising to decide that I better look at another vertical. And so I didn't have to go far, because in my group are people who understand software, understand SaaS sales, understand clean tech. We have half a dozen clean tech investors. We have some folks who specialize in the medical field. And that is just a tremendous resource, because it allows me to participate in arenas that I would never be able to look at any other way, because it's not my area of expertise. We're working on something right now with a data company that really looks like a fascinating opportunity. And I was able to bring in a couple of my colleagues, one who ran sales for Oracle in Asia for 15 years, and another one who created some intense data systems on Wall Street. So they were able to take a look at this opportunity and, size it up pretty quickly. So the key really is to find the person at the angel group who is interested in what you're doing. And they're there, and LinkedIn is a great resource for that, because most of us on LinkedIn will talk about what our particular areas of interest and expertise are.
So if somebody did that, if somebody that had a drone-related company that was looking at how to study erosion and crop things, if they came to you at CEVG and said, hey, I'd like to meet you for coffee, would you meet with those people if someone called and wanted to know more about CEVG?
Yes. In fact, we spend a lot of time in what I would call the advising, mentoring phase before even considering investment. There are a number of us who are involved in a number of the incubators, both in Boston as well as in Rhode Island, down in New York, where we're basically spending a lot of time working with companies, getting them ready for potential investment down the road. So that advisory and mentoring function is something that an angel groups really not just specialize in, but think is integral to the progression of a company and its growing maturity.
Yeah, I would actually say I think a lot of angels really enjoy that mentoring role. And so I think it is important if you go through accelerators or other networking events, it's a great way to meet people. there's a couple things about the cold LinkedIn, it's, I'll do call versus coffee, right? Much less friction to do a phone call versus have to go meet, just so people know that. It's just a time thing. We're all like inundated with things. But also there's other things that groups do. There's a lot of groups that do, like ours, that do office hours, right? We do a monthly office hours. It's open to anyone. That's held out at care.com up in Waltham, and it's a great way to meet our members, kind of no risk, and we'll kind of tell you, you might be early, but this could be a fit for angel funding or not. But there's definitely ways you want to try and start doing that. The last thing you want to do is go to someone and say, I need money and I need it in 2 weeks, right? That's really tough in the angel community unless you're going to someone who's a super angel and can write you that, that 7-figure check that you're looking for. It's a relationship building process. But then, when people invest with you, they're all in and they want to see you succeed.
So let me pick up on that. If I wanted to get out of the phone call queue and into the coffee queue, what does it take? What is a clever thing that I might do?
Warm intros. So find someone who knows me, who knows you, who says, hey, Deb, you should talk to this person, right? Because if I'm going to prioritize, and I was literally talking to a fellow investor yesterday about this. I mean, our email boxes are insane, right? And I feel like I should work for one of the companies I use to help filter my emails. Not filter out, but kind of organize them for me so I can create order out of chaos. But a warm intro. There's a group of people who I know if I get an email from that I want to look at that because they're probably referring someone they've met and they feel like it's worth my taking the time to go meet them for coffee versus just a phone call. And a phone call, by the way, is not a bad thing, right? I can do 4 phone calls in the time I could take me to get somewhere to, or have, go meet someone at a Starbucks for coffee. Right?
Bob, same question.
I mean, I would encourage, the Greentown Labs, for instance, in the clean tech community has open houses once a month where anybody can go and you can meet a whole variety of different people in the industry who are developing companies, as well as investors and people from industry. So those types of opportunities are ones that allow you to meet people within the space that you're trying to develop an opportunity in, and to develop a network. And at the end of the day, what you need is the network. It's not just one individual.
And the other thing is that coffee very often, a phone call very often leads to coffee. And sometimes then to lunch. I mean, you never know how this is going to work out. So, starting with a phone call is not a bad thing. Very often I can refer someone to somebody who is, more knowledgeable about that particular area. Or I can, give them some coaching on the phone and, be able to really have some impact on what they're trying to do. We do office hours also at WeWork. Downtown on 23rd Street, and really, met some great people, and it's fascinating because while as investors we always have a lot of people who want to speak to us. At least in my case, I learn as much from the people that I meet with. I learn as much from them as they do from me. Mm-hmm. So it's very much a two-way street.
I think also, events like this, right? I'm not as familiar with the ecosystem here in Providence and Rhode Island, but I know in Boston there's events all the time. And look out, and if there's a group you want to meet and you see that someone's going to be at an event, go to that event, because we usually make time before and after for networking. And so if you really, I've had entrepreneurs do that who then we bring into our process because they're showing a lot of gumption, right? As a CEO, I like that in a CEO, they're going to make sure they get in front of a customer if they need to. But it's another way to sort of put that face without a lot of friction in the process, at least from our perspective.
So some of these angel networks have a pretty rigid process. Upload your thing, upload the thing. Sometimes you have to cut and paste take it out of your document and paste it into a little box, right? Takes a while. Do you have to do all that stuff, or is there a way around it?
Why is he looking at me?
I'll take for us, it's absolutely critical that to be seriously considered that yes, you submit a request and you provide a pitch deck as part of that request, as well as an outline of the business and activities. So in order for us to have to start the formal process, yes, you have to do that. Now, oftentimes, well before that formal process has started, the company's CEO or other members have made contact with and know people within our network. And so there already is knowledge about the company because they have made that effort ahead of time. Now, we get companies coming in from California and places west where they might not have made that effort, and it's more difficult. The threshold's higher because it's really like a cold application. And sometimes it's much better to know people who know the management before that application comes in. So making that effort is oftentimes very important.
Yeah, and I think to build on that, right? Like our application of what you would have to cut and paste versus just load a pitch deck is it's like a 2-page template. If you can't fill that out, you're probably not ready for funding, right? I mean, I'm being honest. It's pretty simple. It's a 3-year revenue expense, profit or loss projection, right? At high level numbers. We're not looking for the 500-line spreadsheet. If you don't have a sense of that, you probably shouldn't be going for funding yet, and think about some other ways to get the coaching. I spent some time yesterday with a company doing that mentoring. They kind of started the process and realized they weren't ready. Turns out I knew one of the founders from literally 20 years ago, and we're trying to get them to that point, right, to get them ready. But they started the application and realized, we're not ready for funding. And so if you're really struggling with it, think about why. If you're viewing it as that much of a burden to do some cut and paste.
Yeah. So I would agree and say that it's necessary to go through all that. It's absolutely necessary. It's really not sufficient. And what I mean by that is at New York Angels, we get about 150 applications a month. And we are a volunteer organization. We have one paid employee. So it's members who are sifting through all of these applications, trying to whittle that down to the 12 or 13 that we will then ask to come and pitch us during our screening day, which happens the first Wednesday of every month. So as that process goes on, it becomes very clear that without sufficient information, and we have folks who do that, they'll just upload their pitch deck and sign off and say, well, I did it, and I'll tell them more about it when I get there. And the sad fact is that they miss an opportunity, and maybe we miss an opportunity because very often they don't actually get invited in. So what you'd want to do is you really want to be part of that ecosystem. You have to be. But then you want to find the people at New York Angels who are interested in what you're doing. That is just absolutely critical. And you want to contact them and you say, I've applied to come in and pitch New York Angels, and I would like to talk to you about it. And to Bob's point, it's actually much better if you do this in advance of applying. I've run into companies and I've said, gee, this is a blockchain opportunity. We're doing a lot with blockchain. It sounds like a really good idea. Have you ever thought of coming in to pitch New York Angels? And they'll say, well, yeah, I applied a couple months ago and I didn't hear anything. Nobody reviewed it. So I'll kind of dig through the archive and find it and send it to the blockchain guy. And he'll, in this one particular case, he came back, he said, this really looks pretty good. I'd like to talk to them. So you absolutely need to include as much information as you can and realize that, in the early going, that's kind of all we really have to go on to judge whether or not the opportunity is worth pursuing. So it really pays you to put some effort into it.
I think that's what you make a great point about the formal processes. If someone does a formal application for us, right, we try to give them a response. But if someone just, to be honest, about the process, if they just come into my email box, they may get put into spam or other things. And so there is something about being proactive, right, and following up. If you don't hear something, I mean, there's a fine line, right? But you definitely want to think about, well, maybe they missed my first email, ping again in a week or two, right, to see if maybe you get a different response. Or, I might be working it on the back end to find someone to look at it, to David's point, who has the expertise that I don't have.
So there's another part of this, too, and that is I spent a lot of time working with the National Research Labs and also with ARPA-E, and also, for instance, here at Brown with a number of the different departments with the professors as they try to move forward to commercialize research. And I'm a big advocate of the fact that if you really have an idea and that you think that it is commercially viable, that it's absolutely critical to go out and talk to people. You have to go out and talk to customers and potential companies that are interested in the idea, whether because they're in a similar arena or because it's an interesting idea that they might want to explore working with you on. And so that, the National Research Labs have the 100 customer, they train their researchers as part of the commercialization program to go out and talk to 100 different potential customers before they even broach the idea of incremental funding. And I think it's important as you are thinking about commercializing a product that 100 customer orientation is one that also includes your potential investor groups. And so talk to potential investors, angels and others, so you get a sense of what they're looking for long before you actually file that application.
Yeah, but Bob, what if your idea is so smoking, so happening, and so original, you're not really sure you can share it with customers, not even sure I'm going to let it loose with you all until you sign this idea, once it's out, it's out. What about that situation?
Go for it. Yeah.
So there's a whole lot in there, but one is most angel groups will not sign NDAs, right? Maybe one person who's going to really go deep on patent and IP if you haven't filed your patent yet. If you filed your patent, there is no reason. If you've got something that is truly groundbreaking intellectual property, you're probably filing a patent for that, and then once it's filed, you're protected. Right, but even then, we've had some. When it's pre-filing, we'll have one person or two people go in and look and sign that NDA on behalf, to be able to then do the vetting. But the other piece of this is most of this on these ideas are about execution, right? A lot of people have good ideas, but it's all about execution. And for a lot of us, if your idea is that repeatable or stealable, then it may not be something we're going to want to invest in. If someone can be a me too in a very short period of time. And so we talk about what's your moat, right? What are your barriers for someone else doing this? It may not be patents, by the way. It could be locked up some channel partners that, for 3 years that no one else is going to be able to get into that gives you a different advantage. But if your ideal is that copyable, then you either got to go fast and just go do it, but you got to be able to talk to investors about it. I don't know if you guys have anything.
Bob, NDAs?
We typically don't sign them other than looking at potentially patent information. That's not something that we would normally do. So
we don't ever sign NDAs. I've never, ever known a New York Angel to sign an NDA. It's just, and as an entrepreneur who started several companies, a couple of them in stealth mode for an extended period of time, I have tremendous sympathy, but it's just not feasible to sign the number of NDAs that we would need to sign. It just opens you up to, just too much can happen. I will also say that when you start out angel investing, you're kind of looking for that unique product. And when it comes to technology, we've pretty much come to the conclusion that nothing is going to be unique for very long. I mean, does anyone have an idea here that Google couldn't copy if they really, really wanted to? Probably not, right? So we're not investing in the idea nearly as much as we're investing in you. We're investing in the people who are going to drive this idea to market and who are going to be passionate enough about it, committed enough to it, to make it a success.
So let me ask you this. On either the formal screening or the informal screening, do your groups ask about the valuation of the company?
yes.
Yes.
Always.
And what's the right answer?
You always have a conversation about value. And invariably, setting expectations is part of the discussion. And oftentimes it can be a challenging conversation, but it's one that with an appropriate grounding in how we as angels look at the elements of a opportunity as compared to what the founders or the C-suite people are, they gain an appreciation of where we're coming from and vice versa. But yes, value is important.
Yeah, and I think what I like to tell entrepreneurs on this is it's a negotiation, right? You have what you think the value of the company is. We have some ideas, right? But we're also trying to help entrepreneurs see the long game, right? I wouldn't say everything, most of the checks we're writing aren't the one and only check, right? So maybe they're raising $1 million now. In 2 years, they're going to need 3 to 5. We do life sciences. They're going to need 15 to 20 to 30 after that. And so our initial discussions with the entrepreneurs are to make sure they understand what that looks like over time, right? What does the cap table look like? And if you start out, I literally had an entrepreneur we led the round. I had him on a similar panel to this at a different institution. I won't say the one. Then talk about how he was actually happy with where it came out. And by the way, it ended up being lower than his initial ask because we walked him through the process. And to be honest, their next round is going much better because it was a reasonable uptick in valuation because he didn't start out too high. And I think sometimes if you start out too high, it makes the following rounds harder, right? Because it's just going to either be more dilution for everybody involved, and down rounds are hard. Nobody likes to see a down round.
Yeah, I think valuation is critical. It is probably, the one decision that angels can agree on is, an absolutely critical factor in deciding whether or not you're going to invest. We've seen great ideas, really tremendous ideas, where investment was scared away by just a valuation that was going to really inhibit the company from growing and raising the capital that they needed to. And conversely, we will take a bigger risk at a lower valuation because that's where we really have an opportunity to succeed.
Okay, I got another valuation question. So you've given the term sheet. So they said, oh, I think it's this. You guys fainted. Oh, my God, you went crazy. You do your little diligence, and you give a term sheet. Do they have to accept that valuation, or does it sometimes change? And what do you think they can do to nudge it, if anything?
It's a negotiation. Yeah. Right? If you don't like the initial term sheet, decide whether, it's like you're buying a house, right? I mean, in some ways, right? Do you like the initial offer you got, or are you going to come down and, come up or come down in price and negotiate with them? And so I think sometimes I've seen entrepreneurs get a term sheet and they are like, oh, I don't like it. I don't want to, go back. But there's a lot of elements in a term sheet. They're several pages long. It's not just a valuation. There's a lot of other things in there that can help create value for either founders or investors. We take an approach of, we like to be founder friendly, right? A rising tide rises all boats. Like, we want companies to be successful. Look at that, right? Look at how much, what other things are companies or investors looking at that you might be able to give on versus just valuation, right? There's a whole package involved with it. And by the way, I use that process to get to know entrepreneurs, right? Because it's naturally a confrontational process, and it's going to show me how they're going to deal in distress, right? Because these companies are going to have valleys of despair, and you learn a lot in the term sheet negotiation process.
Yeah, there are also there are a lot of terms, as you're alluding to, that really make a big difference and can give angels a lot of comfort, whether it's preferred shares or it's a liquidation preference or something else. So you kind of want to look at the whole toolbox and figure out how to come together on a valuation. It can be a very difficult process. This is on my mind because I talked with an entrepreneur yesterday who we had offered to fund his company at $4 million valuation, and he wanted $6 million. And we just asked him to justify, explain why he wanted the $6 million. And I think he sensed he really had not been able to do that. And came back yesterday, actually kind of confessed that, that was a sticking point between him and his partner. And, that he really wished that we had been able to come to a deal, so.
I also would just stress that it is a negotiation. It's always, if you have a lot of interest from a lot of potential investors, that helps you. At the same time, oftentimes angel groups do band together to get transactions done, and so building that coalition of funding could be important. And so working through terms that are advantageous for more than one angel group basically gives you a better avenue for success in getting to closing. And oftentimes we as angel groups work together. So it's not something that is, you need a lead typically, but but working through those discussions with more than one angel group oftentimes is, or one set of investors oftentimes is helpful.
Okay, so you give the entrepreneur the news, and he says, "Oh gosh, I really want to work with you guys. Let me think about it. Frankly, I'm talking to some other people, and can I just think about it for a week, and then let me talk to some other people." And you guys say, "Oh, that's great. Who are you talking to? I'd love to chat with them." And the entrepreneur says, "I'm sorry, I can't put you in touch with them right now." Is that a turnoff, or is that? What do you think about that?
I wouldn't say it's a turnoff at that stage. I mean, everybody understands that they're negotiating. One of the things that works especially well in our case is when someone comes to us with a term sheet. So we don't have to lead every deal. And if they have negotiated something with another group or another organization and, they have a term sheet, that can obviously simplify things.
Yeah, I think we're sort of missing I think there's something going on in the angel community, right? So VCs, traditional venture capital has gotten bigger. The funds have gotten bigger. They aren't playing as much in the Series A stage anymore. The checks are too small. They can't write $2-3 million checks anymore. It just doesn't return their funds. So, a $2-3 million round, we're even seeing $5 million Series A's or Series Seed, that's usually a Series A. So we have to band together with other angel groups to fund that. It's very difficult for one angel group to fund a $5 million round. So we work together. That being said, if you have two competing term sheets, that's great. Tell me you can't shop mine, right? So the rule generally is I write you a term sheet. You can't go and say, I've got a term sheet from Golden Seeds, match it or do better, right? That's not how it works. But if you're in negotiations with two different groups and who's going to lead, you usually might have a preference for that and then try and bring the other group along because you might need both of them anyways, right? Versus it's not like venture where, venture capital firm A versus B are never going to work together. The angel community is pretty collaborative. I think you've seen that. I mean, Bob and I co-invest in a different group together. It's very collaborative. And so in general, we're all trying to do what's best for the founders, right? We try to be founder friendly on that. I don't know if that answers the question, but and there is, by the way, there's usually a term limit. If we write a term sheet, we say you've got X number of days, right, to get back to us or the offer's off the table, right? It's a pretty standard term in term sheets.
I will say it certainly would be a turnoff if it turned out not to be true.
Yeah, that might be a turnoff.
Yeah.
But also I would highlight the fact that angel investing funds are scarce resources. And so when you look at the number of applications we receive versus the number that get through diligence versus the number that closes, that pie narrows pretty dramatically. And so I would encourage honest conversations with your potential investors, and at the same time recognizing that that they're interested in investing in potentially successful companies, but also the pool of capital that is available at this size of capital, which is seed stage, is relatively modest as compared to the later stages.
Yeah, you just made me realize something I usually say to this sort of question, which is you're building a trust-based relationship. So let's be clear. This is angel investments are usually in the 7 to 10 year before they exit, right? We all wish it was 3 to 5, right? But it can be a 7 to 10 year life cycle. You want to start that with trust versus lack of trust, right? It really is a relationship that you're going into. Your lead investor who wrote the term sheet will usually take a board seat, whether it's that person. In our case for Golden Seeds, it may not be me if I wrote the term sheet, but it might be someone else in our organization who's a really good fit for whatever you need on your board. But you want to start that relationship off right versus with a lack of trust out of the gate.
I actually think it was a New York Angels member who said to me, I want to feel trust acceleration as we get closer to a deal. Something happens, it more than doubles, it accelerates as you get more comfortable. Did you have something you wanted to add?
No, just to agree with you and to emphasize that, we really are investing in people because we all know that ideas are fungible and markets change and things happen. So we're investing in you because we are counting on you to navigate through all of those rough seas. And obviously, that doesn't work if there's not a lot of trust.
Okay. So is everyone thinking of really good questions back there and sort of edging towards the mic, coming up with good ones? Got a couple working? Okay. All right. Let me just ask these guys. I've got a couple real gems in the unportfolio at Slater. Things that I said no to, or things that I lost out on, or things that I was just plain wrong. So was there any fallibility in here? Is there anyone that got away? Anyone you wish you had done differently that is now called Google or something? Or
Everyone?
I think it's fair to say that for every every 10 early stage investments, you typically might have 1 or 2 or 3 that are 5, 7, 10x kind of exit, if there's an exit. But of that pool of 10, there's probably 4 or 5 that never make it, and there's a couple that Zombies. Yes. So the likelihood of success, even if you get funding, is challenging. And so I think we recognize that. I'm a serial entrepreneur. You have to have faith in yourself and your ability to be successful, but you also have to recognize that the risk of loss and the risk of failure is quite high.
and you might even bring preconceptions to the deal that were something maybe you had seen a similar deal before. Who knows what makes you wrong? Sometimes you do bring preconceptions.
So there's a great conflict, kind of the scales of justice between carefully analyzing a business plan and making your decision solely based on the numbers that you're seeing and the analysis that you're seeing and that you can do logically. And the other side of it, which is just this gut instinct that tells you, this is going to work or it's not. And I really erred in the beginning of my angel career, quite honestly, on the side of too much analysis. And, we have a saying at the New York Angels that if 4 of us get in a room, we can talk each other out of anything.
Yeah. We say the same thing. It's very easy to kill a deal.
Right, absolutely. And so there were 2 that I passed on that I really wish I hadn't. And one was a deal for a new trash company. It was actually driven by recycling and by the whole green environment movement. And they had some little bit of traction. It's actually called RTS. They had a little bit of traction, but they were very new. And they're also issuing common stock. So we talk about the different terms. And in common stock, especially when venture capital gets involved, your percentage of the business just gets crushed. And so, logically, there are a lot of good reasons not to invest in this company. But I just, had a real feeling about these guys. I mean, they were just passionate beyond belief. And you just got this sense that they were going to climb over the wall or the recycling or whatever it is they had to do in order to make this company a success. And they have. They were just, so I passed at a $5 million valuation, and they were just funded at a $50 million valuation and given $10 million. They're now in 4 markets. And so it was actually beneficial to me in a way, though, because it kind of helped me reassess those scales. Because there are also a lot of stories about deals that have been analyzed to death, and on paper it looks like they couldn't possibly fail, and yet the market turned, or the entrepreneur couldn't respond, or whatever happened, and it just didn't work out. So I think it's really just a matter of kind of figuring those 2 sides out in your head and coming up with whatever balance you're comfortable with.
Yeah, I think it's interesting because I get this question a lot recently about like the FOMO, like did I miss a deal? And I think, to be honest, there's so many that we see that it is a bit like, I kind of joke, it's like, oh, squirrel, right? Like, it's like, what's the next thing coming, what's the next thing coming down the path? I do follow some that I didn't do, but I like to see them do well. But, I don't know that necessarily I think I always go back to why didn't I invest initially? And those reasons usually still hold. for some reason. There was one, I don't usually like to say the names, but where, I just got a weird vibe from the founding team when we met with them, and sure enough, in this case, the female co-founder left as soon as they got funded, right, very shortly after. Now, they are going gangbusters, right, similar sort of thing, high valuations, et cetera. We're all sort of shocked, the people who invested from our side, but, there was something there. Now, I could still be in that company, it'd be great, it'd be doing great, but, I think you have to go back, I always try and go back to, well, why did I pass initially, and has that fundamentally changed or not?
Was she there to pitch golden seeds, you mean?
No, I don't think it was done, I shouldn't say it was done with malice. I honestly don't think it was. She was a free spirit. Like, the company, once they got funded, was no longer going to be interesting to her, right? She was a true technologist, innovator. What she was now about replicating technology she had built. And so she really then didn't have a vested interest. And that started coming through in our diligence, where, at least I caught that vibe. And sure enough, she got a different offer. She was a market leader in what she was doing, right, technologically, but she wasn't going to be in the company for the long haul.
Okay, I've got a jillion questions here, but does someone have a question they'd like to ask the august panel? Come on, Steve, up to the microphone here so that other people can hear it.
Yeah, so I've been doing this stuff for a long time, and back in the day, you did $6 million deals with VCs who were professional investors who basically spent all their time doing deals and sitting on boards. So the angel world's a little different, right? Because you're getting personal money put into your deal, but who's coming onto your board? Because I think that's a big distinction between the world of VC rounds at 4 to 6 million and the world of angel rounds at 4 to 6 million. And I know, having been a guy raising money from firms, you kind of knew who the players were and you kind of knew their track record, and so you could take their money with some degree of confidence that as board members that they really kind of had their act together. So that's the question.
So for our group, we write about 80% of the term sheets of what we invest in across our group. By the way, Golden Seed's invested 120 companies, over $120 million over 15 years. We take a board seat when we think we have the expertise to take the board seat. And it's, again, I led a deal. I am not the board member, right? We needed someone with really deep technical we had someone as the co-lead with a deep technical expertise, and she took the board seat. As we come to their Series A, we will probably just go back into an observer role. Right, and so we are very thoughtful. It's not just, by the way, we're not the biggest check in that, even though we led the round, but the other investors saw that, my partner, my colleague, had the expertise to be on the board at that time. I think you have to be careful if an investor's writing a big check and saying they have to have the board seat. Like, do they really want control? I'll let others answer. I've got another thing about size of boards that I could talk about. But I think you really do want to ask that question. And we outline it in the term sheet of whether it should be, it's usually a Series seed investor, maybe the lead or maybe not.
Yeah, I would agree that board seats should really be driven by expertise. So I've invested in businesses and not invested in businesses because of who's taking the board seat. Mm-hmm. I mean, that's really, how important that is. So.
It also depends on the expertise of the angel group, per se. I think what we found for our group is that we're oftentimes asked to be board members because we have expertise that would be helpful to the company. But that's just as a function of the types of angel investors that are in our group.
Yeah.
So.
So I would say, so the other thing we get asked a lot is around the size of the board. I sometimes find with early stage companies, they don't want a formal board of directors, and it can be a friction point. We view it as their resources for your company, right? An empty board seat is an empty resource because it's someone, they have a fiduciary responsibility to, as a board member, and so you want them helping you as a CEO or a founding team think about your company. We're starting to we used to be on the side of a 3-person board at a seed stage. When you're talking, a $3, $4, $5 million seed round, it probably should be a 5-person board. 2 common, 2 investor, 1 independent, right? Because you just you want more minds in the room helping you think about how to grow your company.
What's that mean, fiduciary duty? Aren't they just trying to get as much money out of the deal as they can?
No, as a fiduciary on the board, you're thinking about you're thinking about the common stock, the preferred stock, you're thinking about any debt holders on that balance sheet. You can't just be for your own investment. You've got to be for all people who have a financial stake in that company. And it's, that's a key role. And it's we do a lot of training for our board members so that they understand that. It's a very different hat. Sometimes I'd rather be an observer than a true board member because I don't have that fiduciary responsibility as an observer.
Not everyone does that. That's why you should go to Golden Seats. Was there a question in the front here? Grab the microphone behind you.
Thank you. Hey, thank you. My name's Dre. I have kind of a two-part question. So my first question is, as angel investors, how do you decide when something's kind of a flop? If it's kind of just going to be a fad, when you're making your decision if it's worth investing in? And then the second part is, I guess in the angel community, are there second chances? Can you speak to how big reputation is? If someone, if you invest in something, it is a flop, and someone tries a few years later, is that reputation still there? Do you all obviously talk to each other?
I think it depends on the nature of the flop, quite honestly. I told you about that phone call I had a couple days ago from the guy that we offered the $4 million valuation to, and he decided not to take it. Well, he was so concerned about his reputation that he wanted me to know that, that was really not his doing. So he clearly has some other plans and wants to come, back into the marketplace. I think we all go into this with our eyes wide open and know that it's possible to lose 100% of your money, maybe 80% of the time. Failure in and of itself is not eternally damning, where maybe lack of responsiveness or lack of integrity or something like that potentially is.
Yeah, there's some investors who say, they'll only invest you after you have your first failure. Like they've learned, you've learned on someone else's dime, right? I'm only half kidding about that, by the way. I think from a reputational standpoint, by the way, I fully agree. We're expecting, a certain percentage of these investments to not make it through, right? Which is hard to say, but it's true. But I think it comes back to what we talk about: reputation, trust, right? How have you operated as a founder, as a CEO in that process? Were you transparent, or did you just sort of shut off the lights one day and nobody knew what was happening, right? And so I think how you operate through that makes a difference in setting you up for your next, right? It could just be the market didn't pan out, right? It could be you thought it was going to take X amount of time to build a market, and then you know what? It ended up being 3X as long, and really the market shifted in that time. You have no control over that as a founder, and then you say, okay, yeah, let's wrap it up and not have it be a zombie, right? That just sort of keeps petering along. Say, yeah, we made some mistakes. Let's move on, right?
After we tried everything.
After we've tried everything.
Communicated well.
Right.
Okay. Adam, did you have a question?
Did. Hi, my name's Adam. I'm around 2017, and I'm one of the co-founders of Pangea.app. My question is, as someone who will be raising their first seed round, to what extent do I sell on vision, like empowering the future freelancers, or like the little bit of traction that we have, which is like $3,000 in transactions? Like, I talk to a lot of investors who say, I want to hear more traction, I want to hear more data, but we need to rebuild product and keep iterating. In order to do that, we need cash. So to what extent do I sell on traction versus to what extent do I sell on vision and mission?
Great question.
You have to sell on both.
The answer is yes.
Yes. Yeah, and to be honest, why, right? Because show me that you have traction with what you have built, even though you have to rebuild it. I literally had this conversation last night with the founding team. If they've got something built, they have to rebuild it to really scale. But I was like, show me you can actually sell what you have, right? Because it's basically the MVP, the minimum viable product. Show me you can get people who want that, and I'm willing to put money in to help you rebuild, the speedier, spiffier version of it, right? But if you can't sell even the MVP you have, it makes me wonder, right? So you got to be able to sell both.
David? Anyone else? David? Okay. Yes, Tim.
Is there a threshold for the minimum size of the addressable market below which it's hard to get angels' attention?
Addressable in what sense?
the total expected size of the market, so if you got 100% of the market share and it was, say, under 100 million, is that just not big enough, or is there a threshold? Or is it more the opportunity, the investment versus the expected exit?
I don't still understand your question. Are you saying that if the total addressable market is
Too small.
is too small,
Right. Is it something that gets thrown in the trash right away? And if so, what is the size of that market?
I think there's two ways to look at that, I would suggest. One is, what's the value equation associated with the product? You can have you can sell a drug to 1,000 patients and sell it for $100,000, and that is a viable market for some drug companies. But I think it's much more of a question of you want to be able to look at a market that's large enough where your growth over time will create that 5 to 10x valuation that investors are looking for.
Yeah, I think for us, the way we look at it is, we throw a number out, but it really varies by sector to some extent, and it also relates to the amount of competition, right? So life science is a little different. They have a patent on that drug. No one else is going to be able to sell it, right, for a number of years. If we like to see that you can get to a reasonable revenue number, presuming you only get 5% of the market. Like, we never presume a company is going to get 100% of a market, right? So you have to show me that at 5%, you've got a viable company that'll give me that return ratio that Bob said.
But the number you throw out,
We throw out a $500 million market.
okay.
I mean, of course, I say that, and we have exceptions to the rule every single time, right? I mean, so there's always exceptions, but that's just sort of a threshold number that we throw out there.
A safe one to use.
And you have to say that when you're weighing the analysis versus, your gut instinct on whether or not to fund a business, a large addressable market can potentially cover a lot of sins, right? You can be modestly successful in a very large market and still come out okay, which is not true in a smaller market.
But you could also look at this and say, the opportunity is a platform technology. You're looking at a relatively small market to initiate the platform, but it can be expanded into other segments. And so part of it is, what's the strategy related to the opportunity?
The beachhead.
Yeah.
So what if someone comes out and says there is a $450 million market here, because I more than estimate, there's 375 incumbents in the U.S. Here's a list of them. I've talked to about 100 of them so far, and I have a pathway to cover roughly 66% of them in the following way. Does that mitigate the size, and if not, what might?
You'd have to really show me that you can own 66% of the market, right? I mean, again, there's got to be some sort of a barrier to entry that you control, right? That's going to prevent other people from coming in. I mean, we rarely, I'd say, see anyone who says they can take more than 20% of a market, and even then, it's something I would haircut once I get into your financial models, right? I like to play in the numbers as a consultant, so I get into the spreadsheets, and I'm going to want to understand your assumptions and how you get there, and really stress test those assumptions.
On the other hand, in the example that you're giving, you're talking about somebody really doing their homework to the point where they have, devised a plan to saturate, to a large degree, their addressable market, and that's very impressive. So if that's something that really holds water, that would absolutely be an advantage.
I personally love it when they know the names and they can say that revenue's concentrated in the top 16 and here's where they are, and these people can, I just love that intimacy with market. Okay, any other, yes, John.
Thanks. One quick question. How would you advise entrepreneurs assess respective angel groups? It seems that it's a little easier maybe with VC, where you've got a panel or a board of a dozen partners that you can look at their background and know what kind of networks they could plug you into. But with a sprawling network like New York Angels or Golden Seed, there's folks that are coming out of the woodwork that might be able to help but aren't quite as available on a website to understand. So like if you have a couple different angels to select from, how would you recommend you go about evaluating who's the best fit?
Great question.
I have a very low-tech answer to that. It's, try them all. I mean,
Yeah, I would see who in your network might know them and ask about them. I actually thought you were asking a slightly different question, which is, I love it when an entrepreneur asks me to speak to one of my CEOs that I'm involved with, right, where I'm on their board or that we've invested in as a group, right, because they're our best advocates about what we can do. And as founders, find out who the good people are to work with, right?
Okay, I think I saw one more question in the back. Jason, or maybe another. Okay, Jason.
We don't have a huge number of students here, but I'm curious about the team question. It's always team, team, team. We invest in people, not in ideas. What's the advice that angels have for first-time entrepreneurs, especially young first-time entrepreneurs? Is it a non-starter? Should they just not try? Should they go work for another startup and come back with their idea later? Or do you say young, first-time, no problem for angels?
Great question.
I can start on this one. 75% of what we fund are first-time entrepreneurs at Golden Seeds, all ages, right? You find first-time entrepreneurs at all different stages of their careers. For us, it's about, I say solo founders are very hard to fund, right? It's very rare. I've got one in my portfolio, which is over 24 companies. But she had a team. She's a manufacturing company. She's got a team of 50. She'd already had a team and a facility and things like that. So show me that you can build a team versus you're a solo operator. For folks who may not have the expertise or the gray hair, your advisory board matters. Like, who are you starting to bring around you as advisors who are willing to, that you pick up the phone and we know that they will answer your call and be helping you, is a really good way to get that, some kind of credibility beyond you. I think it's hard coming out. We just had this discussion today, actually. I think it's really hard coming out of university. I think graduate work, especially PhD, like researchers, I think it's easier because they're trying to commercialize something they worked on. I would never tell someone not to go start their own company, but I think it's definitely riskier.
As angel investors, we love ground floor opportunities, and that's kind of the ultimate ground floor opportunity. We actually started a fund a few years ago in New York called the Entrepreneurs Catalyst Fund, which actually addressed this very issue and provided a one-time $100,000 of funding for, I think it was 8 or 10% of the company. And we funded about 20 companies like that, and some of them did quite well. So, I think it's very much a question of the individual and, what their idea is really all about.
Okay. Yes and yes, but first in the middle. And Kevin, you're the exit question.
Hi. In working with angel groups, I've seen them take two forms. One in which everybody invests individually, and one in where the group kind of votes and they invest more like a fund. Can you tell me a little bit about your structures and what you see as the advantages to each formulation?
Well, at least for us, we have an angel group, which each of us invests independently. We also have a institutional fund that can invest as a single entity. And so we have both kinds of capital. So we're a mix.
Yeah, so Golden Seeds, individual investors make their own choice. What we do is that if you reach a certain threshold of investment, we'll form an LLC so that we're pooling the capital on our end, so we show up as only one line on your cap table. And then that helps in terms of any votes or other things that happen, right? We just have to get a majority of the LLC to vote. We can get back to you very quickly. So say you end up with 25 investors from our group, it's one vote. Granted the proportion of the shares, but we only need 13 people to respond to be able to respond back, right? So we try to make it easier for you to manage a cap table. It's how our group operates.
So we source deals together, we do due diligence together, but we invest individually. So, but we also have a fund. We have a sidecar fund. If you reach a certain threshold of investment, it might be 7 angels and $350,000. There's a matching fund that will come in and automatically supply, additional money, and that's been derived from angels investing in this fund. So for folks who kind of want to ride along on what the New York Angels' best ideas are, they have a way to do that. So it's actually, close to what you were talking about, kind of a combination of the two.
Yeah. There are some groups out there, I can't name enough, but where it's it is majority of the angels have to vote, like they've somehow pooled capital. I don't think anyone up here has that approach.
Okay, Kevin, last question.
So just a quick comment first. A 4-page term sheet doesn't sound founder-friendly to me. Sounds more like what I used to get from VCs all the time. But the question is more, you mentioned friends and family and then angels and professional VCs. What hasn't been discussed is the new ability to crowdsource funding, whether it's a Kickstarter, I got a prototype of a product, I essentially take pre-orders and raise money to commercialize, or now you can actually crowdsource equity investments from non-qualified investors. Where do you see that, and do you interact with any of that?
We are not interacting with crowdfunding at the moment. I think the general feeling is that we're a little bit surprised it hasn't done better than it has. Not that there's not a lot happening there. There certainly is, but we're not really participating in that at the moment.
Yeah, there's a lot in that question/statement. Kickstarter, I think, is a great way for companies to start. But the equity crowdfunding, we as well aren't really playing. We're seeing more that have done some equity crowdfunding starting to hit our radar, and we're trying to sort through what does that mean from a regulatory standpoint. Right? There's a lot of regulatory issues around that, and it's still fairly new. Something to caveat here that I haven't said, which is, less than 3% of companies that we see get funded. That doesn't mean they're not good companies. It just means they aren't right for our angel group, or maybe they're not right for angel investing at all. But there's other ways to fund companies through Kickstarter, through customer prepayments, et cetera. So not every company is going to fit the kind of profile that we want. Quickly on the term sheet, they are more like VC term sheets. The reason why is over 30% of our companies go on for VC funding. If you've got a dirty term sheet early, it makes it very hard to go for VC funding later. And so we've just accepted the standard NVCA blanks for a lot of our documents. And to be honest, if we do that negotiation early, it makes the documentation stage and the follow-on rounds really easy, because everything's standardized or ready for what the VCs are going to want later. Versus there were a whole lot of other things out there. Every term sheet was different, and it ended up being a brutal process when they would go for larger VC rounds. So it is probably a bit more onerous, but we view it as short-term pain for long-term gain.
Okay, so these guys came a long way from out of state and dispensed some incredible advice and some really thoughtful observations. So on behalf of the Nelson Center for Entrepreneurship, Brown University, and the Slater Technology Fund, let's give them a warm round of applause.